Hey guys, this is BK and welcome back to BK with Stocks or Stocks with BK, however you want to say it. We're talking about investing in stocks. And today we're going to be talking about stock options. And this is going to be just an introduction into just buying a call option on stocks, what it is, what it kind of looks like. We're going to look at an example here. I do not recommend doing options until you fully understand every part of options, the delta, the theta, all that. But today we're just talking about call options, kind of the basic introduction to kind of keep it simple so that if you're interested, you can go learn more about it. I've traded a lot of options, and I myself didn't even feel confident for the first few months of learning about it. And then when I finally did, it really was a good moment of clarity when I finally understood what everything meant and why. So I'm going to try to make it simple. We're just going to talk about just call options. Disclaimer, I am not a financial advisor. I'm not licensed as a financial advisor. You should consult one before investing in the stock market because investing in the stock market has risk and you could lose all your money. So this is for educational purposes. Let's jump into an example. Now here's what a call option is. A call option is saying that I think Moderna, which is currently priced at 170.61, by let's say May the 21st is going to go to 180. I believe it will be worth that. I want to buy one quantity, that's one contract, which is 100 shares. So you need to understand that one quantity is always 100 shares. When you buy stock, 100 shares is 100 shares. When you're buying options, like a call options, one quantity, one contract is 100 shares. And that's just the basic thing you need to understand kind of how many shares you're purchasing. And what you're purchasing is if the stock crosses 180 by then, you have the right to buy the stock at that price at 180. So if it went to 200 and you wanted to buy 100 shares at 180, you could. But most people trade options as in they sell the options to other people that are exercising the stock and buying the shares. So here's how it works. If we go over here to this chart over here, we're going to see what it looks like. So right now the stock's at 170.61. So to buy in the money, this is what this shaded area is. To buy in the money, if we were to buy the call for 170, saying in the end of May 21st, strike 170 strike price, we're going to be 170 or above. It would cost us $15 per contract because, again, there's a high likelihood of that happening because maybe the stock's on a good upward trend and we're going to play it safe and go in the money. When you buy an option, we're buying it for if we buy it for the 15.25, the goal is to sell it for like 16, 17, 18. As you can see, as it goes to 165, 160, that the further in the money you are, the more the contract's worth. Buying out of the money, as you can see, is a cheaper premium. That means like it's a cheaper chance of getting it. You might make more money off of it. A lot of people like to buy in the money and when it goes up, make a little bit of money, but some people are trying to make a lot of money on a price. So an example being would if we wanted to really go out there and like let's say we thought we were really gonna like make some money on this, we could go to 200. Let's say we thought Moderna was about to release big stuff, which Moderna's already moved from about 122 to 170 in the last 3 weeks. The question will be, can that continue right now? I doubt it until we get another earnings report or they come out with something else. I do think Moderna is cheap right now, but I wouldn't buy this option because that's a huge move in the next few weeks. When you're buying options, it's important to look at catalyst. But like an example of an option that I would want to do is something where the premium is low, and that could be a lot of different things. But let's look at GE as an example, General Electric. So General Electric, a lot of people are predicting it like people are bullish saying it might go to $17 this year. So let's say by June, we thought they were going to hit that 17 mark. These contracts trade for 10 cents. I mean that's so cheap, but if you look like the return what it could be, yeah, it could be a lot. I mean, if it were to reach that and you got that, it'd be a lot. But the chances of moving that far are very hard because it hasn't made big moves. I mean, it has gone up a lot. You know, it moved from 7 to 9, 9 to 10, and now we're up at the 13 range, and people think it could even be 17 this year, and I think it's great. But that would be a bullish option contract, which you could buy a lot of them. And if you hit that mark, you would get a great return. I mean, in theory, you could get at least a 5, 6, 7, 8x return on that. That's some big money. So this is why people trade options, but the risk is limited if it makes sense. When you buy a stock, you're tied to the company. When you buy an option, this total cost you're going to end up spending on here, that's how much you stand to lose. Options are definitely volatile. They can kind of go up and down. I think the biggest mistake people make is they think it's this simple and they don't pay attention to these other things, these delta and theta and all this stuff, which you need to learn about. And I'm not the person to explain it, but there's some great videos on it actually. And it took me months to kind of understand those. People recommend options and explaining why based on volume. That's a good one. But like the GameStop guy, like Roaring Kitty, he thought GameStop would go up, so he bought the $12 strike price for last Friday actually, and this was like a year ago, and it was like $5 a share when he bought it, and of course it's at 180 something dollars, so he made millions of dollars off that purchase, just because he believed that it was an undervalued stock, and he was right. I mean, for whatever reason, it worked out. So if you want to buy options, you need to look into it, and you need to look at this stuff up here: the bid, the ask, the volume. The bid versus the ask is what the ask price is what they're asking for. The versus the bid is what you can just get it for at this time. So that's an important thing to kind of look at. I'm not going to go over puts, but puts are important. They're like a safer way to play. You think a stock might be going down, or for some reason like that. So that's one way to look at it. If you're interested in call options, you need to read, watch some videos, listen to the Nigerians are great people for this. There's a lot of great options traders, but watch videos and learn how to do it before you just like follow someone's advice, because you need to understand why they're trying to find cheap premiums as versus buying a Moderna one for $10 or $12. Why they're trying to find a cheap one, and why they think the stock will go up by a certain time frame, because that matters. Catalyst matters. Earnings dates matters. You need to know what a company's doing when their earnings date is. So that's something to consider. Anyway, I'm BK, and this was a basic look at how to buy options. If you like this video, hit the like button, and I'd be glad if you subscribed and stuck around. See ya.